trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. And good afternoon, or I should say morning, it is here for us. We're recording early once again. But to all of our market rebels, and Stu, how are the pre-markets looking right now?
How are they looking? They are looking
up
small, really
small, yeah.
like basically nothing, but
basically.
up, better than down, I guess.
Better than down big, right? That's we're just looking for, make sure we didn't hit that. But one of the things that we always try to bring to our viewers out there and to our Q&A people are not so much the things that everybody else knows. We find that's what everybody else teaches. Let me show you how to sell a put for income, or let me show you how to predict the markets. They all just regurgitate the same stuff. We want to give you insights that you're not going to find anywhere. We're not saying it's necessarily right or wrong. We just want to give you a different perspective and things to think about. And today, Stu, I think this really drives home the point because it's something that you and I have talked about many times. And we find that many traders don't use vertical spreads to the best of their ability. Not to the best of the trader's ability, but to the best of the strategy's ability. And we're going to find out why that is. It's kind of a very nuanced point that a lot of people miss. So let's start off with our chalk talk. So here we go. Everyone, think about this. For vertical spread, should you try to hold out for maximum gains, the difference in those strikes? Or should you close for smaller profits prior to expiration? Now, if you talk to most people, I'll give you a little clue here. Most people are very bent about, oh, grab those profits. I always love it when they say, let's lock in those gains, which is
let's
really,
move on to something else.
Which is really a misnomer.
Let's move on to something else from something that's working. Yeah, that's a
exactly.
really good idea.
We're in something that's working. In fact, it's in a position where it's going to work even better. But let's close that because psychologically it feels good that we've locked in this gain, even though we're going to roll that into another strategy. That's why I don't really call it locked in. You're not parking it under your mattress and saying we're going to pull this out of the markets. It's still exposed to risk. But what happens is that people get very tempted because they hear about vertical spreads being limited risk, limited reward. They like the limited risk part. And because of that, they're even cheaper than call options, which are already highly levered.
Highly levered.
And so if they can grab a 50-cent profit, it looks magnificent on a $1 spread or something in terms of percentages. And we find that so many people like to close these out for these guaranteed.
Yeah, I buy them at $1, sell them at $2. Oh wow, you made
double my money, right?
You made 100%, but you made money to buy a McDonald's burger or something.
That's the whole argument. So now we're going to find out why. Again, something to think about from a professional trader's view, why we typically lean away from that idea. So the topic for today, are you closing vertical spreads too soon? Now, again, most people would say, oh, I can never close it too soon. As you get a profit, you grab it and go. And we're going to find out why that's probably going to backfire in a spectacular way with vertical spreads.
Yeah.
So let's get started with that.
And while we do this, I've kind of seen what Bill's going to show you here. A lot of times I don't, but this time I have. Keep in mind that the probabilities, we're going to show you some math and some probabilities, but probabilities are just that. Just bear that in mind that they are probabilities, and it's not this is a definite, there's always going to be that tail. There's always going to be that other side of the high probability, which is the low probability. And there's not really an answer. There's several answers. There's different courses of action. That's what Bill and I are here to do. Just make sure that you understand the background and where these numbers are coming from and where the probabilities actually do lie. And then, of course, you're free to make your own decisions.
Exactly. So before we get started, please remember marketrebellion.com/get started. Lots of great topics just like this, all designed to help you make better decisions. So let's start off now. I think we've seen this before, but here is a simulation. Let's say our stock is at about, I think for the simulation, it's at 100, but let's just say it's shifted higher to 102.50. It's right between 100 and 105. Now, the first thing to notice is that we have a cajillion, and that's putting it mildly, different possible paths. And this is the first thing to understand, that everybody thinks they can predict where a stock price is going. Mathematically, for all the math people out there, this is the higher level of infinity. This can't even be counted. The number of possible paths that we can get are too numerous to even count. So think of it this way.
The stock price he's talking about, paths of the stock price.
The paths, right. So think of it this way, if you were to take a dart and say, I'm going to try to hit a particular path in here, or I'm going to, through technical analysis, tell you which path you're on, your chances of doing that are zero. They're mathematically zero. So when people say, oh, well, here's where this, or here's where I think the stock is going, you have to say, well, is that really the best way to approach it? So the first thing to notice here, we've got a stock at 20% volatility for 252 trading days in a year, but roughly a year. And I'm going to assume that we have these little buckets down here, let's say maybe 10 cents wide. So maybe we have 100 to 100.10, and another bucket from 100.10 to 100.20. And what we're going to do is we're going to count all of the times that these different paths landed in these buckets. And if we did that and counted up, we would get a histogram that, guess what, would be a bell curve. So that's where that's coming from when we're looking at things like Black-Scholes models and things. We're saying, based on the current volatility, what's the expected range? And if we know the expected range, we can figure out what the option is worth. But now think about this. Let's look at a couple of dotted lines between 100 and 105. That's actually a little too wide, but I had to do it just to give you some separation in there. But the point that I want people to see is that that range relative to the bell curve is very narrow. So if you had the 100-105 vertical spread, and this was of course, most people aren't going to do a 1-year spread. I'm doing this as a starting point just to make the point. But if you had the 100-105 vertical spread, that's the area where you have to land inside that spread. So statistically, what's more likely, Stu, that we're going to land in the red area or not in the red area?
I'm going to go with not in the red area, Bill.
Big time, overwhelmingly big odds that we're going to land somewhere other than the red. That turns out to be important, because what that means is that the overwhelming majority of the times you are going to either be at zero, spread loses 100%, or at maximum value.
Bill, weren't we just talking about this in our one of our
we did, yeah, we briefly
150 implied volatility, $70 stock, where it was a 5 or 6 point vertical spread.
Right.
That's exactly what this is.
Yeah.
Way too narrow.
Way too narrow. Yeah.
For the probability of movement.
So you have to understand that the first thing is that statistically, which remember is how we want to approach it, what is most likely going to happen, not can you predict which path we're going to be on. That's a losing game. The better way to approach it is what's more likely. So we have to say, all right, it seems like more often than not, a spread should either be worth 0 or its maximum value. Maximum value meaning the difference in strikes. In this case, we have the 100, 105 vertical, which is 5 points. Now that's what we call the payoff. Obviously, we have to subtract out the cost to find out your profit. But the payoff for a vertical, most of the time, is either 0 or the difference in strikes. Now, again, most people aren't going to do a 1-year spread. I did this again just to kind of really make the point. But let's say if we did it for 30 days, we still get the same thing, but we can see that the spread here is not as wide as it is out here. Right? Over time, it tends to fan out and become even wider. But we can still see that here, maybe it looks like a third, roughly maybe a third of the area is here between the strikes, a third here and a third here. But that would still mean that 2/3 of the time, you're not between the strikes. You have a 2-to-1 odds against you about being in the strike, between the strikes, even at the short end of the curve. So that's kind of the starting point for the philosophy here, that we have to understand for vertical spreads that they're mostly what we call a binary payoff. Not perfectly, it's not a binary option, either 0 or 1, but it behaves almost like that. Most of the time, we're 0 or maximum gain. So if we look at our vertical spread, here's like, let's say a 95-100 vertical. If we look at the bends, which are the strikes, again, what's more likely? That we land between here? Remember, we've got some kind of a bell curve up here saying here's the distribution of possible prices. What's more likely? Between, think of these as football goalposts. What's more likely, that we land between the posts or over here or over here? Overwhelmingly odds against you about being between. And yet that's where most people end up closing. So now let's find out why this turns out to be such a problem, Stu. And to do that, we're going to go to our little Excel spreadsheet that I put together. So I got this idea. This came from the FIU days when we used to do it in the financial engineering classes. But I put this together.
Give me just a second. By the way, everyone, was the professor of. He wasn't the student. He was the guy.
Yeah, I was teaching it. So anyway, let me just take a second to explain what we're looking at here. Up here in red are anything in red you can change. So these are stock price, volatility, interest, days to expire, time to expiration in years. 0.0822 is 30 days. And down here are 2 different strikes we can choose. So it's going to figure out, so you can see right there, I was quite happy with this too. There is the entire Black-Scholes formula in one line telling us the value of the 100 call.
Yeah, I don't think you could do that though.
There is the value of the 105, and of course the spread is just the difference, would be 242. So I could change this, let's say, to 110, and you can see it's going to change that to 100, 110 vertical spread. We've got to pay more for it because we're receiving less.
Bill, I have a question for you.
Yep.
Were you able to put on one line what it took those dudes like decades to come up with?
Well, I'm not taking credit for that. They came up. I just put the formula in Excel terms. I'm not taking credit for that, but I had to put it in Excel terms. So that's where that's coming from, and that's how we're generating these numbers. All right. So far so good. We're just getting call prices. Now down here, I have Excel picking a random number from 0 to 1. So we're just closing our eyes, drawing a random number. Okay, easy enough. And then we're going to put it into a bell curve. And it's going to pick a stock number based on this starting point. Stock's at 102.50. And it's going to say, if we were to randomly pick a spot, one of those paths, where did we end up? In this case, at the end of 30 days. In this case, 103.30. And if that's true, the $100 call would be worth $330, and the spread payoff would be $330, right? Because we own the 105 is worthless, and the $100 call would be worth minus $1.56 because we paid $242 for it. I'm sorry, we paid $487 for it. So we're down, and then we're going to say what's the P&L. Now we're going to account for the cost. We made 89 cents on the spread, so the spread was profitable. We're not counting commissions, so it gets a 1 under the profitability. And the call was not profitable because it's negative, so it gets a 0. So I'll leave these out here for later. So right now, all we want to do is to count the number of times that the call is profitable versus the spread. Now I've got 1,000 rows down here. Okay, so we're going to do this simulation 1,000 times. And what you're looking at is the distribution of the call, which you would expect, very long tail out here. Sometimes we hit home runs. Lots of times we end up with losses. But look at the spread. And this is really the point of our coach's corner here. It's mostly a binary payoff. We get these kind of these goal or these bookends, right? The goalpost is between, but we get these bookends. So let's run the simulation a few more times. I'm going to hit F9. Look at that. Still get these bookends. There it is again. See, it's mostly a binary payoff. Not perfect, but that's the point that you have to understand if you're trading spreads. So what's the point here? Well, take a look down here. 437 times, that's 40, let's call it 44% of the time. You took maximum loss. And over here now, this spin is also a loss. We got minus signs in both of those. So you're taking some kind of a loss on these two bars. But 30% of the time, you hit maximum gain. But now take a look in here. All right, that's a losing bar. We don't want to look at this. What's the midpoint here between minus 50 cents and roughly positive 50 cents? Roughly a quarter. After commissions, not much to speak of. That's going to happen. That happened 3.7% of the time. Over here, between 56 cents and $1.56. Questionable, but might be worth taking for some people. But that's 5.3% of the time. And then over here, $1.56 to $2.55, we got 4.8. And I just realized I should probably switch over to here. That we got 4.8% of the time. But look at this, for the maximum, 39% of the time. So the question is, if you're closing your spreads with just, as we call it, picking up nickels in front of bulldozers, let's say you did it down here. Think about what's going to happen in the long run. If you take roughly $1, 5% of the time, but you take the maximum loss 44% of the time, what's going to happen there, Stu?
You're going to run out of money, Bill.
You are going to absolutely 100% dig yourself into a hole. Even down here, even let's say, oh, well, I picked up $2 on this. Yeah, it's going to happen 4.8, at least in this simulation, was 4.8% of the time. And yet 44% of the time, you were exposed to a total loss. So even if you're grabbing these that seem good and certainly look very good on percentage terms, what's going to happen there in the long run? Same answer. The point is, when you are trading vertical spreads, if you are going to survive these in the long run, you've got to kind of hold out for this, because it's just about equally likely for as total loss. That's the only way you're going to balance those out. So let's run a few more sims here. You can see that you always get these bookends, right? And look at these down here are just almost, relatively speaking, nothing. They're very low percentages. So it sounds good and it feels right when you say, oh, let me grab this $1.50 because I only paid $2.50. But keep doing it, and you're going to see that because you're always exposed to this bar. Now, watch what happens just for the, like we looked on that first graph there with all the different price paths. Watch what happens if we go out to a year. What happened to that area between those dotted lines? What should happen to these bars here, Stu? We got less area out there. They should get squashed. So let's go out to a year. Look at that. See, now we can clearly see the bookends. Here we got 54% of the time. And here about 41% of the time. And yet we got these little tiny percentages. Look at 1.1%, just very tiny percentages of some decent profits. But again, if you're grabbing these and not holding out for these, you're always exposed to this. Now, I also added, and that's what these final two columns were out here, that these are the percentages that we came up from the simulation, 31.4 and 44%. But the actual numbers would be about 36.9 and 50.4. All right, so that's just kind of for comparison. We can see that they come in right about with the expectation. This should be somewhere around 36 or 30. We got 31. Obviously, there's some, look at the standard deviation on that, 23 versus 2.5. That's another reason spreads are nice. They give you a lot more consistency in those returns. but we can see that we're kind of in the ballpark there. If we bring it back down to, let's do, can't see here in the dark, let's do 30 over 365. There we go. So now you can see that 39.5 and 50.4, they're coming in much closer to what we would expect. But take a look at this. You hit the maximum gain 37.5% of the time. You hit worthless 40.3, and you landed between the strikes 22% of the time. But between the strikes, there's a lot of different bins. Some of those are still not worth much after commission. Some of them are just okay. But look at the discrepancy in those percentages, even with 30 days to go. See, if we come out here to 60 days, change that to 60. So now you're only talking about 17, almost 40% out here on the bookends. So the whole point to take from this is that if you're trading spreads, you should at least be thinking, doesn't mean you have to, but you should at least be thinking, this is kind of my goal. And yet for most people, it's not. It's let me grab the 75 cents because I only paid 238, and that's a phenomenal percentage return. And they forget that you're always exposed to this. And that's the kicker.
So Bill, here's the trader in me coming out. So are we suggesting then that if you have a 5-point spread, we should hold out for $5?
That should at least be your, again, kind of from a philosophy standpoint. Now, let's talk about why we shouldn't say that that's a blanket statement, that that's all we do. And the reason is, here's a vertical spread. We know here's our current curve. As time goes by, what happens? The left side shrinks. We're in negative theta, positive gamma zone. And the right side gets closer to the black. We're negative gamma, positive theta. So watch, after maybe 30 days in blue, that might be a few days later. A few days later, we keep moving up this way. So what happens as time goes by? We start magnifying the gamma. We start magnifying our deltas. What are the deltas right here on this brown line? You can't see them over the black. They're getting close to 1. But what were they back here? They might be 30.
Yeah. So what's going on
so now
here,
you've got
everyone?
a very small chance for that spread. The stock might be moving up here, and you say, okay, let me grab the 50 cents. And what people don't realize is if you just sit there over time, that's going to push it up. Or even if you're down here, you now have a much, much better chance that you're going to get accelerated to here.
So here's the thing, everyone. See, this becomes the age-old question of, well, what's the stock going to do tomorrow?
Right.
See, it's like we get this question all the time. Well, I have this spread on. Well, number one, why aren't I getting $5?
Why am I not getting $5 for it?
$107. It's through my strike. Well, that's another issue. And secondly, should I hold out? After they get an explanation, it's like, well, maybe I'll just hold out. But then what if the stock falls? See, that's the dilemma, which comes back to, well, you put the spread on, you were bullish. We're talking about a cost spread here. You were bullish on that name, and you put the spread on because you didn't want the tail, and you were, you wanted to hedge your downside somewhat.
Mm-hmm.
You were hedging your hedge, actually, when you did that.
Very good.
And now you're thinking about taking it off while you're still bullish. You're going back to trading your P&L, which
that's right.
9 out of 10 times is going to be a mistake because there's too much emotion involved. Yeah. So unless you really changed your opinion for whatever the reason,
or have good news that says it's
about
worthwhile
the direction of the stock, it's like,
right.
In English, what am I saying? If you're not bullish anymore, this stock is bearish now. And all right, well, I guess it's time to get out of your bullish deltas. But if you're still bullish and you're saying, well, I bought them at 2 and now they're 3, I don't really get why you're getting out. Yet you see, I made $1 on 2 and I'm up
50% and 5,000% annualized. Let me close it. Right.
And what the spreadsheet is trying to show you here, that the odds are in your favor to hold out.
Hold out.
Do you
And
hold
part of
out
it,
till the very last second? And the only way you're really going to get 5 on this, everyone, is to go through the exercise and the sign. That's how you're going to get 5.
again,
Nobody's going
right,
to pay you 5.
right.
But, we're traders. So are we willing to dump it at 490 or
Probably,
480 to
yeah,
let somebody else pick up those couple pennies?
yeah.
Absolutely.
But it
Absolutely.
also, on a related topics too, what if the stock is, let's say, at 106? How many times do we get this in Q&A? Oh no, the stock has gone through my short strike. Do I buy it back? What do I do? The
Yeah, do I
answer
buy
is
the 105s back?
nothing. Look what's going to happen over
No,
time.
no. Your odds are increasing
Increasing.
that you
Let them
will get
increase.
a better,
That's exact.
that you will
Right.
get the payoff
You're going to
on
get
that
the full
spread.
payoff. That's
Yeah.
exactly what you want it to do. It's
Yet
exactly where
yet
you
they're
want it to be.
trying to unwind that
Right.
by buying it back because
Right.
people are panicking about, "Oh my god,
Panicking.
I went through my short." It's still like your long delta. It's that, you know what? This is like, "Oh, I have this covered call on, I'm long delta, but I really want the stock to go down to go under my strike."
No, you don't.
What? What? Are you kidding me?
Right.
You want the stock to go down, but you're bullish on the stock.
Yeah.
Please explain. It doesn't make sense.
Well, it's why a lot of people get hurt with options and with derivatives. That's why we try to teach people the fundamentals and the mechanics, not here's where I think the stock is going and buy a call or a put. So another thing that I think might be an argument, a good argument for saying let's consider closing it. We're getting very close to expiration. We're on this brown line, this very steep gamma, and the stock is right here.
Mhm.
Ugh, you're going, man, yeah, we're going to get full gains, this extra little space between the brown and
You
the
want
black
that
if we
short
hold.
counter.
But if we get one little whiff down this way, we could be coming way back down to here.
Yeah.
One little puff of wind, and you're going, ah, man, I don't know if it's worth holding. So that might be a case for saying, all right, look, we've got, or maybe we've got earnings coming up or some type of a volatility event. We say, you know what, this is an exception, let's close it. But under normal circumstances, if there is such a thing, if the stock is up here at 106 or 107, I'm holding it. It's exactly what I want it to do.
Yeah.
Go for that maximum gain.
The prize got delivered, and now you're saying, "Well,
And now you're saying I don't want it.
I
Right.
don't really want it."
Let me
Right.
grab
And
the
and again, it comes back to that, am I still bullish or am I not still bullish? If you're
right.
not still bullish, I guess it's time to dump it. But if you
Well,
are still bullish, then why are you getting rid of it?
and we actually make that distinction too. Up here, you're not really bullish, you're not bearish. So if the stock is up here, you don't really need to be bullish. You just don't want it to fall. So a lot of traders mistake that. They say, I don't really know if the stock's going to be screaming up this way anymore, or maybe it's going to be going slow. Doesn't matter. It can get stuck right there in the mud and it's still going to hit maximum value. So it's different from bullish. Down here, you're bullish. You need that stock to move. Up here, it's really more not bearish. We just don't want it to fall.
Wait, are you trying to tell me, Bill, that if I have here's my thing. If you have a debit spread, you can actually be collecting dollars. Oh my God, how does that happen? I'm paying for a
Positive
debit
theta.
spread. I'm actually collecting dollars.
Yeah,
Look, everyone, this is all part of options. This is the theory behind it. That spread up there is actually moving, delta wise, it's actually moving towards zero,
that's right.
right?
So
Your
here's a
long
question. Here's
delta
a
coming in and
here.
it's moving towards zero. You want it to be zero because at zero, you've achieved maximum gain.
Here's a related question, Stu, on that. This spread that we're looking at here, is this a debit spread or a credit spread?
I don't know.
Well, I don't know. And yet a lot of people, because if you put that it's going to cost you money, they say, oh, well, it's a debit spread and it's therefore negative theta. Well, no, if it's a debit spread with the stock up here, you're positive theta. Well,
Yeah.
wait a minute. I could do a credit spread up here because they usually start up here and it's got positive theta. True. But if it gets down here, it's going to flip. See, that's the whole point, is that it depends on where, because we have two different options. And so it depends on where you are. So yeah, this could be a debit spread and you could still be in a positive theta negative gamma zone, just like a short. Yep. So anyway, we hope that gives you some good things to think about. Again, we don't want people to misinterpret it to say that you only hold out for maximum gains. We're not saying that at all. We're saying that it shouldn't be your go-to strategy to pay 250 and say, well, I picked up 75 cents and that's a big percentage return and let me move on, because you're always exposed to that very big bar, roughly 33% if it's a 30-day option, for maximum loss. And that means you need to try to push that other extreme to balance those out. So that should be more of your, at least a focus. So the question
Trade,
here, Chalk Talk, for vertical spread, should you try to hold out for maximum gains or close for smaller profits before expiration? And the answer, I think we just gave it, you should at least strongly consider holding for the maximum gains, because if
but
you're,
again, don't take that to mean if I have a $5 spread, I have to get 5.
no, of course not. But
No.
it's just saying that you need to get towards that right wing over there,
Yeah.
as opposed to saying, let me pick up 75 cents.
And the statistics show that.
They
Trade the issue. Don't trade the P&L.
Right.
Trade the issue.
The issue is that you've got two bookends out here, a massive one that's going to cost you big time if it loses, roughly 33% of the time. And yet you've got a beautiful one over here that can counterbalance you. And most people say, I'm just going to erase that. It's never going to be part of my trading plan. That's what's going to cause long-term losses, even though you're trading a limited risk, limited reward position. And so I think with that, it's probably a good stopping point. I'm sure it's going to bring up a lot of questions for our Q&A people, which we'll see you later at noontime today. And for everybody else, we hope that helped. And we will see you next Thursday for Coach's Corner. We'll see you then.